you're buying a home, how can you be sure that you're getting the mortgage loan that's right for you? In this video, we're going to dig into the options that are available, some of the pros and cons, and who they're going to work best for so that you can make the right decision for yourself in your home buying journey. Hi, I'm Bethany, and I'm a realtor with Keller Williams. I've been helping my clients accomplish their real estate goals for 18 years, and now I'm going to tell you what you need to know about buying your home. If you want to make the home buying experience a lot easier, hit subscribe, sign up for those notifications, and keep listening. Let's start first with our loan options that are insured by the government. VA Loans. The Department of Veterans Affairs offers 100% financing through lenders to home buyers that meet eligibility requirements based on their military service. If you are not a service member, then you are not going to be eligible for this loan. Banks and lenders nationwide will offer this loan program, and some of the perks of this loan are that eligible service members are going to get 100% financing. So that means no required down payment. The program also offers interest rates that are lower than other loan options that are out there, and there's also no mortgage insurance premium that's going to be added on to your monthly payment. You do need to be aware that a VA loan is going to include a one-time funding fee. It's about 2.15% of the loan amount, and that can be added on to the amount of the home that you finance. And if you're buying, let's say, $200,000 home, that funding fee would be an additional $4,300 on top of that loan. So that would bring your grand total of the financed amount to $204,300. You can generally expect to need a credit score of somewhere in the 620 to 640 range to qualify, although there are some lenders that might go a little bit lower on the score. One downside of the VA loan for some home buyers is that the home has to be in really good condition with no obvious repair issues. You'll have to pass a VA appraisal inspection and also provide a clear termite inspection letter. This means that if the roof is leaking, if the flooring is missing, or there's obvious peeling paint, you are not going to pass that appraisal inspection. This also means that most foreclosures are probably not going to qualify for VA financing. Some buyers might view the condition requirement as a downside, while other buyers might really appreciate that they're being guided and encouraged, to purchase a home that's in really good condition. USDA Loans. The Department of Agriculture offers 100% financing as well through lenders, and they're looking to help home buyers with low to moderate income that are interested in buying in less populated, rural and suburban areas. You should know that the home does have to be located in an area that is eligible for receiving the loan, and you, the buyer, also have to qualify based on, your credit, your debt, and your income. There are income limits on this loan. There's going to be a threshold of how much money you can make based on your state, your county, and also the size of your household. The cap is generally 115% of your area's median income. USDA loans also have a funding fee of 1% that can be added on top of your financed amount. And USDA loans also have some additional mortgage insurance premium that's going to get added on to your monthly mortgage payment. So if you're buying, again, a $200,000 home, your funding fee is going to be $2,000, and you can finance that in for $202,000. It's great not having to put any money down, but it is going to cost you a little extra every month because you do have that mortgage insurance premium that's tacked onto your payment. And if you don't want to live in a rural area, then this program probably is not the right fit or option for you. FHA Loans. FHA loans have long been a favorite of first-time home buyers because the requirements are not as strict in order to qualify. You are going to need a minimum of a 580 credit score, and you'll also need 3.5% of the purchase price as a down payment. So if you're buying a $200,000 home, you're going to need a down payment of at least $7,000. buyers. This is really helpful for buyers that would not be able to qualify for some of the other specialty loan programs that I'm going to mention here in a minute because of their credit score or their income and debt load. And it also allows them to have a lower down payment than the conventional mortgage loan option. Historically, the interest rate for FHA loans is also going to be lower than conventional rates. You do need to be aware that FHA loans require that monthly mortgage insurance premium, and one of the big negatives of the FHA product is that your insurance premium is never going to go away until you've paid off your home. Another downside is that there is a required one-time upfront mortgage insurance premium. It's kind of like that VA USDA funding fee. This is either going to be included in your closing costs that you pay, or it's going to be rolled into your total mortgage amount. And this upfront premium is also in addition to the monthly mortgage insurance that you're going to be paying. So with an FHA product, you're going to have a higher cost of doing business here, and you have that higher cost because of the lower down payment and the lower credit score requirements. Similar to a VA loan, homes are going to have to be in really good condition to qualify for FHA. So if you're thinking that you're going to try and get a good deal on a foreclosure, an FHA loan is really likely not going to work for you. Conventional loans. Conventional loans are not insured by the government, but instead they are insured by private lenders and investors. The credit score requirement for this loan type is going to be higher than an FHA loan, coming in somewhere in a range of 620 to 640. The minimum down payment for conventional is going to be a 5% down payment. And if you're not putting 20% or more down, you are going to be paying that mortgage insurance premium here too. With conventional loans, the mortgage insurance will eventually go away once you've reached the 80% loan to value ratio. And if you remember, this is not possible with FHA loans. If you're thinking that a foreclosure is something that you're interested in, a conventional product is probably going to make that possible. And that being said, the home can't be a complete train wreck and still qualify for conventional financing. But out of all the other options, this one is the most likely to be compatible with a foreclosure home. Let's talk now about some special financing options. Please know that I'm really only going to give the highlights about these because it is super location specific, and you will need to do some digging to find out what the options are in your area. And your Realtor is going to be a great resource to educate you about which options are available. So let's talk about down payment assistance and grants. These types of loans and grants are usually going to be offered through a state agency, a county program, or special city funding. You'll want to check your state, the county that you're looking to live in, and then the individual cities in your area and see what they may be offering to home buyers like you. It could be a grant and you're able to use that grant as your down payment, or it could be an actual loan product specific to that area. These programs are often targeted to buyers who don't own any real estate at all. They have lower to moderate income and generally average or higher credit scores. Think at least 620 for a credit score. Of course, you have to be buying a home in that location, in the state, county, or city that's offering the program to be able to use it. There's frequently a maximum income that you can make, and that is going to vary from one area to another based on your market's average home price as well as the average income. These types of loans are probably also going to have some other conditions that you need to be aware of when you are considering them. Typically, the home will have to be in good condition, so foreclosures usually are not going to work. A lot of these assistance and grant programs are going to require an inspection from a program-approved inspector, and you may or may not have to pay for that out of pocket. Based on the inspector's findings, they could also require that certain repairs or replacements get made in order for you to buy the home. There could also be some restrictions on the age of the home that you purchase, like can't purchase a home built prior to 1990 or 1978 or whatever it may be. For me, the biggest thing you need to know about these types of programs is that you are often required to live in the home for a minimum period of time in order for that assistance and grant to be forgiven. So if you need or want to move before that deadline, you are going to have to pay back some or all of the assistance that you received. What does that look like in real life? What that means is selling the home quickly to pay it back, or having to pay the money out of pocket, if you end up deciding to rent the home out and turning it into an investment property. Depending on the program, that assistance you receive could also be paired with any of the other loan products that I've mentioned previously. Let's talk about some other 100% financing options. So for buyers who have good credit and meet the other guidelines, a few select banks are going to offer 100% financing options. In a lot of cases, you're going to need a credit score of at least 680, and some of these banks are going to require scores of 720 or higher. This is going to be found at a very small amount of select banks and credit unions in your area. You should know that the interest rate on these loans, they typically can be a little bit higher, but they usually do not include mortgage insurance, or if they do, it's going to be a reduced cost for that. This usually makes the monthly payment really competitive with some of the other loan options that require a down payment, even if it's only 3.5% or 5%. The benefit of using a loan like this is that as a first-time buyer with no down payment requirement, you keep more money in your pocket, and that's going to help you offset the cost of moving and buying your first home. And in many markets, you're still going to be paying less every month than you would if you were renting. Some other benefits are going to be that these loans are generally not location restricted, like the rural housing loan, and typically they don't require any repayment requirement or penalty if you decide to turn the home into an investment or a rental property later on down the road. And I find that to be a tremendous benefit. So now that you know some of the basic requirements, deciding which loan is best for you really needs to be a discussion that you have cooperatively with your real estate agent and also with your loan officer. They should know both your short and your long-term goals. And when you pair that with your financial situation, you guys are going to be able to decide which option makes the most sense for you. Knowing the loan options available makes things feel a little more under control, but I'm kind of curious, were you surprised to know that you had so many options? If so, you're going to want to watch the video on your screen now so that you can find out what else you might be missing in the home buying process.